We've all heard the famous Warren Buffett quotes, right? Be greedy when others are fearful, all that stuff. But what's the real secret sauce behind his incredible success? Today, we're going to skip the sound bites. We're going to deconstruct the core logic that turned a dying textile company into one of the most valuable enterprises on the planet. So let's start with a major critique. Elon Musk once said that Buffett's way of getting rich is, quote, pretty boring. And, he kind of has a point. There's no chasing crypto trends, no flashy high-tech gambles. So is his method just an old-fashioned relic, or is there a timeless genius to all that boringness? Well, if this is boring, sign me up. The numbers tell a pretty incredible story. From 1965 all the way to 2023, Berkshire Hathaway delivered a compounded annual gain of almost 20%. That's nearly double what the S&P 500 did over the same period. This isn't just a lucky streak, folks. This is the result of a very specific and very powerful way of thinking. But to really get that logic, we have to rewind the clock. Because the Warren Buffett that we know today, well, he didn't start out with his famous philosophy. It was a journey, an evolution, that began with a completely different playbook he learned from his mentor, the legendary Benjamin Graham. Graham's original strategy was called cigar butt investing. I know, it's a weird name, but the analogy is perfect. Imagine finding a cigar butt on the ground with one free puff left in it. You pick it up, take that last little puff of profit for free, and then you toss it and look for another one. You're buying junk companies for less than they're worth, squeezing out that last bit of value and moving on. And for a young Buffett, this worked like a charm. But then came a moment that changed everything. His business partner, Charlie Munger, basically sat him down and gave him some pretty radical advice. He said, Warren, you have to abandon the cigar butt strategy. Munger's point was that it worked, but it was small ball. To build something truly massive and lasting, Buffett had to completely change his thinking. And this, right here, is the pivot that changed investing history. Buffett shifted from Graham's idea of buying a fair company at a wonderful price to buying a wonderful company at a fair price. Do you see the difference? It's subtle, but it's everything. The focus was no longer just about finding a cheap stock. The new game was all about finding a high-quality business. Okay, so what does the shift to quality actually look like in practice? Well, it really boils down to a pretty simple four-part checklist. Let's break it down. First, he looks for a moat. Does the company have a durable competitive advantage that protects it? Think of a castle. Second, is the business inside his circle of competence? In other words, is it something he can actually understand? Third, what about the management? Are they honest and capable people you can trust with your money? And only after checking all those boxes does he get to number 4. Is the price fair? Notice that price is the last thing he considers, not the first. So that's the theory. Now, let's see how it works in the real world, with what's probably Buffett's greatest investment of all time, Apple. It's really easy to forget this now, but if you go back to 2016, the narrative around Apple was terrible. The headlines were all saying it had lost its innovative edge. For the very first time, iPhone sales were actually down. The consensus on Wall Street was that Apple's best days were behind it. But all that fear and negativity created a massive opportunity. Apple stock got so cheap that its price-to-earnings ratio dropped below 13. I mean, think about that. The market was in full panic mode, which meant a truly wonderful company was suddenly selling at a very fair price. So, cornerstone number 4? Check. But here's the genius part. Berkshire saw what almost everyone else was missing. While the rest of the world was obsessing over quarterly iPhone sales, they were looking at the moat. They realized the true value wasn't the phone itself. It was the ecosystem. The App Store, iCloud, iMessage. Once you're in that world, you are a very, very sticky customer. It's incredibly hard to leave. So what was the result? Their initial investment of around $35 billion exploded in value to become worth a staggering $173 billion. That is the incredible power of focusing on the long-term quality of the business, not the short-term market noise. Now, this strategy isn't magic, it's not foolproof, and there's this myth out there that legendary investors don't make mistakes. So let's stress test this whole framework by looking at one of Buffett's most famous and most criticized deals. Yep, we're talking about Kraft Heinz. This deal is constantly held up as proof that Buffett lost his touch. The stock has been an absolute dog, the headlines have been brutal, and it's cost Berkshire billions on paper. And look, the critics have a point. Buffett himself has come right out and admitted they overpaid. He thought the brands had a stronger moat than they actually did. So, case closed, right? A total failure? Well, not quite. Because here's the wild part. When you actually look at all the cash they've gotten back from the investment over the years, even this gigantic mistake has generated a positive return of over 6% a year. Let that sink in. Warren Buffett's worst investment was still profitable. That just shows you the incredible resilience of his core principles.
So, what's the big lesson here? If you strip everything else away, what is the one timeless takeaway from all of this? It really comes down to a fundamental truth about how wealth is actually created in the stock market.
There's a ton of research on this, and it all points to the same thing. Almost all of the stock market's long-term returns come from just 4% of companies. A tiny handful of elite businesses drive nearly all of the gains. Everything else? It's pretty much just noise. Buffett's entire philosophy is a machine built to find and own a piece of that 4%. And that leaves us with one last really important question to ask ourselves. In a world with endless headlines, hype, and distractions, are you focused on finding that elite 4%? Or are you just getting lost in all the noise?